Hey everyone. So today I want to do a video on Upstart's earnings. Um, Basically, right after earnings, they crashed by about 25%, down about $14 a share. They've recovered somewhat today. They're sitting about 1706. End of the day, high of 1736. Basically, the numbers weren't great. They were a bit of a dumpster fire, so they're necessitating the sell off. Um, they basically revised guidance downwards. Their revenues were a decrease of 31% from the previous year, and they had a loss from operation of 58.1 million, which was down from a positive 28.6 million the prior year. So there's not really much good to talk about in the numbers and in the financials. So I'm not going to really concentrate on that. Anyone can kind of look those up and see what they are. Um, you know, it's hard to pull positives out of this. They're having a really hard time as a company dealing with this macro environment. So today we're going to talk about some of the things that they talked about in the conference call and some of the positive things that we can see in their presentation deck. So um, basically, they've facilitated over 30 billion loans by this time. 75% of the loans are instantly approved and fully automated. They did stress this a couple times in the call, just that they're getting to be more autonomous, and they've also reduced their staff by about 140 over the last quarter to meet the current demand of what they need for people approving loans and reviewing these things. So basically here you can see the chart. Revenues sequentially been declining since Q1 of 22, and same with net income has been going down, contribution profit's been going down. However, the percentage of contribution profit basically did go up to 54%. So I think that's actually stable from last quarter, but was up from the previous quarters. The part I want to point out here is, and stuff that they really stressed in the call, was model accuracy improved as much as 4 months in the prior 2 year. So they're getting a lot of great data that they can work with right now, just to improve their modeling and their risk parameters and make their AI better. Their reached its highest level to date at 75%, as we said. Small door loan volume increased 4 times from prior quarter to over 9,000 loans. And really specifically, I want to point out bank and credit union partners. So if you look at this year over year, last year in Q3 they had 31 bank and credit union partners. This year they're at 83. So that's more than double, getting close to triple the amount of bank and credit union partners. So that's something that's going to matter a whole lot when things start to turn around and things start to swing the other way for the macro and interest rates. Grew small business loan volume from 1 million near 10 million from prior quarter, right? So we know that they're expanding from personal loans. They've gotten a lot into auto loans, and now they're starting to handle some small business loans. Mortgage loans is something that they're planning on starting to tackle next year. So these things are going to be great for diversifying the company and getting them to a better place. Here, this is basically a comparison of their model compared to traditional FICO scores. So 5 times more risk separation than traditional FICO. Basically, they're able to provide loans to a lot of people that wouldn't typically receive a loan and better loan rates. So this is why that their platform is unique and why they're a company that banks and credit unions and businesses want to partner with, right? And including the AI auto approve feature that they have as well. So this Upstart Macro Index is something new that they've added. CEO Dave, he really stressed this this here, that they were able to quantify basically an algorithm that their AI is able to use for underwriting the model changes and basically tracking borrow characteristics. So basically they're able to use this to help judge default rates and how they should be balancing risk as things progress in the current macro environment and as as it moves as progressive. So it's a predictive thing that they're implementing. Basically here, it's just a return to mean of the default rates, right? So their current forecast is they're anticipating, you know, an increase in loss variance on defaults. So basically something that their AI is tracking and something that they're trying to account for. And then here you go into the cash flows and where they're expecting a gross return year over year, right? So here, I just want to point out a few things on, not so much on this slide here, but into their balance sheet. Currently cash on hand and restricted cash, they have 829 million. Something that they pointed out on the call was when they were asked by an analyst, basically like, what's your run rate look like? They have a substantial run rate as long as they're conservative. Like I said, they downsized by about 140 people. Currently, they're about 15 million per month burn rate. So doing the numbers, if they aren't spending cash on any more buybacks or acquisitions or anything like that, they have 4 or 5 years worth of cash on hand, assuming no growth within the company. Their total assets and liabilities is still in a decent place. The biggest thing on this slide is just the amount of transaction volume, number of loans that decreased. And, if you look at this year, transaction volume number of loan, they had 362,000 last year. And with 30 some odd financial partners. This year, they're in the 80s of financial partners, and they're 188,000 transaction volume number of loans. So it gives you kind of a number to work with. So like in the event that things start going the other way, people are more interested in acquiring loans because that's decreased substantially right now. And then also on the other side, institutions and banks are interested in buying the loans off their marketplace. This is going to increase quite a bit. So as the macro changes, I'm expecting, we could see this number swing wildly to the other direction extremely quickly. Basically if they're able to do this number off of 31 and they're sitting in, like say they're sitting around 80, 90, 100 when the market starts to swing, there's a possibility that their transaction volume number of loans could increase to 1 million in a very short period of time. Their transaction volume in dollars has been decreasing, right? So obviously they've been focusing on the small loan side of the business there. However, this could change as well as interest rates improve and people are more willing to take out those larger loans. Their fully automated loan has increased 2% quarter over quarter, and then has increased 8% year over year, right? So that's averages about to exactly the 2% quarter. So this time last year they could be at a 83% fully automated. As well, their conversion rate has decreased substantially, which no surprise there. As the conditions improve, their conversion rate's going to increase. So something I want to talk about too is just a lot of the questions that they got from analysts. They're all kind of very short term. I mean, these are typical analyst questions. Hey, how are you managing this short-term issue? How are you managing this short-term issue, this short-term issue? And management had all great answers to that. Basically, they're not focused on the short term. Like I said, they've made a few corrections to protect themselves, reduce their capital spending and stuff to basically weather the storm. But everything that they're doing is setting themselves up for a long-term success. They just wanted to stress that. Basically, as they get the mortgage business underway, they do more personal loans, more small business loans. That's going to de-risk them as well. And they very much had a long-term focus for the AI and what it's able to do as far as auto approves and manage that risk and create even better access to capital for people using their platform in underserved demographics. So here we see the big increase in loans held in their balance sheet on the auto side. They're doing a lot more testing on the auto side. So 230 million up to about 400 million. However, the other has decreased substantially, and then core personal increased. So basically, the core personal loans that they have there, that's basically there's not as many buyers willing to purchase these loans off of Upstart's marketplace, right? Because that's essentially what they are. They're a marketplace, and buyers and sellers. And in an environment like this, there's less people willing to take loans, and there's less people willing to buy those loans. So that's why it's such a precipitous drop off, just like the real estate market. Less people are willing to sell their homes, less people are willing to buy homes, and you get this massive drop off in activity, and that impacts Upstart's business significantly. So Upstart's definitely like shaking out to be a bit of a bellwether company as far as in tough macro environments. I think they're always going to kind of struggle. However, as we saw last year in really good macro or lower interest rate environments, the amount of net income that these guys produce and cash flows is going to be pretty insane. So here we have fee revenue of 160 million. Net interest income was actually negative 25 million. Highlighting the contribution margin, net income loss of 87 million next quarter. Adjusted EBITDA of negative 35 million next quarter. However, 89.3 million shares. So they have they did do some buybacks last quarter. We'll see if they continue to do buybacks. I imagine they probably will leverage a little bit of that capital they have on hand. If the share price stays around $15 a share, they're going to slowly decrease these shares. So if you are an Upstart shareholder, and you are willing to hold on for the long term, I really believe the company is setting themselves up for a situation where when things turn around, we could see some explosive movement out the other direction, right? Basically at this time last year, the company was just putting out insane growth numbers, and they got priced like these insane growth numbers were going to continue, and then they didn't. So now the company is getting priced the other way because they're trending into the negatives, things are going down, so they're being priced in that regard. And now we have a market cap of approximately 1.5 billion on less than 100 million shares. So yeah, it's something that's painful, but the company's got the cash on hand to weather through it. It just might take a year or so, and if you're looking at the numbers like I'm looking at the numbers, not this quarter's EBITDA, not this quarter's net income, but looking at the growth in loans and products that they're offering, and the growth in the amount of banks and institutions using their product, I think when things turn around, these guys are gonna be explosive in their growth once again. So I'll let you guys kind of go through all these numbers if you chose. I don't want to spend too much time just breaking down like the nitty gritty financials. Like I said, the numbers were incredibly bad, so there's no point trying to hide that fact. It's just a matter of, do you want to stick around and wait, or do you want to sell and move on? There's other companies out there they're also quite good. I'm looking pretty heavily at SoFi right now as well. SoFi had a great quarter, and they actually rocketed up after hours and then sold off the next day. So that one's getting very intriguing. I might start rolling in and DCing into SoFi. I really like the CEO over there, Anthony Noto. I really like the products that they're coming out with. I like what they're doing. It would be nice if SoFi would come out with something in Canada so I could have a look and play with their app. But until that happens, I just kind of gotta do some more research online and see what they're doing. But yeah, Upstart is just kind of one that I've just kind of holding on to, wait to see what happens. Not advice. Do what you have to do. But yeah, if you like Upstart, if you like Tenet, if you like fintechs in general, like I do, then have a look at SoFi as well. or vice versa. If you're in SoFi and you want to look at a couple other companies, look at Upstart, look at Tenant. Tenant's got a pretty wide array of services they're doing. They're getting into data, and they're doing some different products. They're not just servicing loans. They're trying to become more of a business hub to SMEs. So it's definitely different from like a hardcore fintech service like some of these others. But I think holding these three companies kind of gives you a nice wide range of exposure to the fintech space. And I think we just kind of weather the storm and get out the other side. These companies will start to receive the multiples that they're due in time, right? As their businesses grow, and they just compress some more. So appreciate you guys listening to this video. If you enjoyed it, like and subscribe, and have yourselves a good night.